Two people apply for a 30-year mortgage in the same week, in the same city, with the exact same credit score, the exact same income, and the exact same down payment percentage. One gets offered an interest rate of 6.5%. The other gets offered 7.25%. Over the life of a typical mortgage, that 0.75% difference can add up to tens of thousands of dollars in extra interest paid for two people who look, on paper, financially identical. Neither one did anything wrong. Neither one has worse credit. The gap exists because a mortgage rate isn't actually a single, standardized number generated from a fixed formula the way most people assume. It's the output of a negotiation most borrowers never realize they're having. It's an uncomfortable thing to sit with, that one of the largest financial decisions most people ever make can quietly hinge on something as simple as which lender's website they happen to click on first, rather than anything about their own qualifications as a borrower. Mortgage rates feel like they should work the way advertised interest rates for savings accounts or credit cards seem to work, a published number based on a credit score tier that applies consistently to anyone who qualifies. And to be fair, credit score absolutely does influence the rate a borrower qualifies for. But according to research published by the Consumer Financial Protection Bureau and multiple academic studies on mortgage pricing, the specific rate any individual borrower actually receives depends heavily on which lender they apply through, how that lender is pricing risk and profit margin that particular week, and whether the borrower shops around or simply accepts the first offer presented. Factors that have essentially nothing to do with the borrower's own creditworthiness. This distinction matters enormously given the size of the loan involved, since even a small rate difference compounds across decades of monthly payments, meaning the outcome of a 5-minute conversation with a loan officer can end up matching more, in raw dollar terms, than years of disciplined effort spent building a strong credit score in the first place. Let's start with the basic mechanics of how mortgage rates actually get set at any individual lending institution, because the process involves considerably more moving parts than a simple credit score lookup table. A mortgage rate starts with a baseline tied to broader financial markets, typically anchored to the yield on mortgage-backed securities, which itself moves with overall bond market conditions. From that baseline, individual lenders then layer on their own margin, an amount reflecting that specific institution's operating costs, profit targets, current loan volume goals, and risk appetite, which can vary meaningfully from one lender to another even on the exact same day. The technical process works like this. A large bank trying to hit a specific quarterly loan volume target might price rates slightly more aggressively to win business, while a smaller lender with less competitive pressure or higher operating costs might price the same borrower's loan several tenths of a percentage point higher, purely reflecting that institution's internal business priorities rather than any difference in the borrower's actual risk profile. This is where an invisible pricing mechanism takes over, one most borrowers never see clearly explained anywhere during the mortgage application process. Loan officers and lenders typically have some degree of discretion in what's sometimes called a rate sheet, a daily updated pricing grid showing available rates and the fees or credits attached to each one. A borrower who doesn't ask questions, doesn't request to see multiple rate and fee combinations, or doesn't mention they're also shopping with other lenders, often gets offered a rate closer to the top of what that lender's pricing grid allows, sometimes referred to informally in the industry as par plus a margin the loan officer or lender is comfortable charging without pushback. A borrower who does ask, who mentions a competing quote, or who explicitly requests the lowest available rate for their credit profile, frequently receives meaningfully better pricing purely because they signaled they were paying attention to the number, not because anything about their underlying financial qualification changed in that conversation. There's a related invisible mechanism tied to timing and rate locks specifically. Mortgage rates fluctuate daily, sometimes multiple times within a single day, tracking bond market movements in something close to real time. The specific day and even specific hour a borrower locks in a rate can meaningfully affect the number they end up with, independent of anything about their application. Two borrowers with identical financial profiles applying through the same lender just 1 week apart, during a period of market volatility, can receive noticeably different rates purely due to that timing difference, a factor entirely outside either borrower's control or financial responsibility. Two real-world patterns make this concrete. Research published by the Consumer Financial Protection Bureau analyzing mortgage rate data across large numbers of borrowers found significant rate variation among applicants with identical or nearly identical credit scores and loan characteristics, a pattern the researchers specifically attributed to differences in lender pricing strategy and borrower shopping behavior rather than underlying credit risk. A second pattern shows up in studies specifically examining how many borrowers obtain multiple mortgage quotes before choosing a lender, which have consistently found that a substantial share of borrowers, in some studies well over half, accept an offer from the very first lender they contact, without gathering a comparison quote at all. A behavior directly correlated in the same research with receiving measurably higher average rates than borrowers who obtained even one additional competing quote before deciding. This particular finding tends to surprise people the most, since obtaining a single additional quote requires relatively little effort compared to the size of the financial decision itself. Yet it remains one of the most commonly skipped steps in the entire mortgage process. This challenges the common assumption that a mortgage rate is a fixed, objective reflection of a borrower's creditworthiness, determined almost entirely by a credit score and handed down uniformly by an impartial system. In reality, a meaningful portion of the rate any specific borrower receives reflects which specific institution they happen to apply through, what that institution's internal pricing priorities were on that specific day, and how actively the borrower participated in negotiating or comparing that number against alternatives. The friction point isn't that lenders are engaged in outright deception. The rates offered are typically legitimate, available prices that institution is willing to accept. It's that the mortgage shopping process presents itself with the visual authority of a standardized system. What a meaningful share of the actual outcome depends on borrower behavior that has nothing to do with credit qualification at all. Zoom out, and this same quoted price depends more on negotiation behavior than qualification. Pattern shows up across plenty of other major financial products. Auto loan interest rates have been shown in research to vary significantly based on which dealer or lender a buyer works with, and whether they negotiate the financing terms separately from the vehicle price itself, independent of the buyer's actual credit profile. Salary offers during job negotiations follow a similar pattern, where research has consistently found that candidates who negotiate receive meaningfully higher starting compensation than equally qualified candidates who simply accept the first number offered, a gap that has nothing to do with either candidate's actual value to the employer and everything to do with whether negotiation happened at all. In every one of these markets, the first number presented functions less like a fixed, final answer and more like an opening position, one specifically designed to hold if nobody pushes back against it, which means the actual price two equally qualified people end up paying can diverge significantly based purely on whether either of them treated that first number as negotiable in the first place. So the next time two people with seemingly identical financial profiles end up with different mortgage rates, it's worth remembering what that gap actually represents. It probably isn't a reflection of one person being a meaningfully safer borrower than the other. It's more likely the visible outcome of which lender they happen to choose, what that lender's pricing priorities were on that particular day, and whether either borrower did the work of comparing, questioning, or negotiating a number that, despite its official-looking presentation, was never quite as fixed as it appeared to be.